Hello, subjects of crypto. Welcome back to another episode of Subject Crypto. I am your host, Ethan, and today I got a great article to share with you guys. It's very important. I felt like I just needed to get it out there. I chugged a monster, so hopefully we're going to be able to get through all of this in a timely fashion. So, taking a look first at the overall market, Bitcoin sitting around 0.17%, Ethereum 2.5%, XRP 1.5%, Chainlink popped off at 10.75% in the last 24 hours, and Tether has maintained their $1 stature. Everywhere else has been about 1%. A couple people have been, or the lower caps have been a little bit more outperforming than others. But generally, for the most part, everyone is kind of neutral to positive. So, that being said, we're going to go on to the Bitcoin chart. If we're looking still at, I'm looking between an upward channel and kind of a horizontal channel. So, either one I look at is very still plausible. Now, we're looking at a nice little bounce off from this support, and we're possibly going to go retest somewhere up higher. Could be anywhere from 12,000 to 13,000 or 12.8. I'm not too sure. But these are my targets that I'm looking at. First target here, second target somewhere in between here. And that would indicate very nicely that we are still in a bull scenario, which I think we are currently, but it would just be nice to have that kind of reassurance. But let's look at some other ones such as Litecoin. I know we got some fans of Litecoin out there looking pretty crazy in terms of the fact that their chart is just a wick. But we're entering some good times to potentially buy in a little bit. Looking at Ethereum to Bitcoin has done very nicely today. We're going to take a look at how much the comparison of that has gone up. So just in the last 24 hours, we're looking at 2% in increase comparative to Bitcoin. And we had a nice little rounded bottom here. This is very healthy looking. It looks like, and according to the stochastic RSI and the squeeze momentum, we could be getting a further price action upward. But this was a very solid level, and if we broke through that, it might be a little catastrophic. So, but luckily we got through that, and I think we got a little bit more upward action to go. So, without wasting too much more time on that, and let's get right into this article. Otherwise, this video would be probably an hour long. And I don't want that. It would take a really long time to upload and all that. But, so, the United States is going into hyperinflation. I came across this. This was notified to me this morning, and that's why this video is coming out a little bit later, because it took a little bit of comprehension just to get my ideas formed and all that in terms of this stance that they are trying to take. So there's going to be a lot of charts, there's going to be a lot of me explaining, and hopefully I can do it the best of my ability. So the first point in which the hyperinflation stance could be brought is the spending. So this chart right here is the current government receipts, the blue line, which is the income of the government through taxes, and then we have the red line, which is the current expenditures. So this year, the government in the United States has spent about $9 trillion, while earning probably about $3.5 trillion. This has a deficit of $5.5 trillion, and that is a significant amount. If we take a look at previous recessions, such as back in 2008, these numbers were not nearly as drastic as they are now. And that's kind of what brought me to further researching this article and just going through it, is that these numbers are very dramatic. They're way bigger than they were in the past. We had the little mini recession back in like 2001 to 2002, and we maintained very well back then. And then we had this little divergence between the expenditures and the receipts, and now it's even greater. It is phenomenally, these numbers are massive. I don't even have words to express the differences. So we got the budget deficit 5.5 trillion, which is shown in the chart. And so comparative to other government spending, you can just kind of see where it is. It's like this yellow line here is the same as the yellow line from the previous chart, but it shows in terms of a negative number comparative to the other accounts that the government has for trade balance and things like that. So this is just a further broken down chart in comparative to like where the government is spending the money. So continuing forward, what really started solidifying the fact that this is happening to me, and I didn't really, to be honest, I didn't even know what this ratio was until today. So we have the deficit to outlay ratio, which is at 60%, and 40% is considered to be hyperinflationary. So what this is a percentage, and it's the current expenditures. So it's that deficit, the 5.5 trillion, the difference between the expenditures and the receipts divided by the current expenditures, which gives us a percentage in terms of how much the spending is. And looking at this number, we have reached a hyperinflationary range. We've passed the 40%, we're up to the 60%, and that is a significant amount in terms of spending to earning in terms of the government. And this is a problem because they didn't have that money to even have the stimulus, and so they had to print that money because that money didn't even exist. And these numbers are so high that they have significant impacts on the value of money itself. So this next part is a little bit less macro and a little bit more microeconomics, because it's in terms of the businesses rather than the governments interacting with one another. But the latest quarter two GDP data is pretty insane, especially for the way that it turned out. The economy shrank 31.7%, and that's just a generalization. It's the same as the GDP going down. So this is saying that the GDP went down 31.7% in quarter two of 2020. And this all happened while the stock market continued rising. And everybody knows, like, we got on the S&P 500, on the NASDAQ and the Dow, we've got all-time highs this year, while also being in a pandemic, a time of economic downfall. And it just really doesn't make any sense. So this chart here kind of shows that as the total market capitalization, and this is essentially the value of all the businesses divided by the GDP, the production of all the businesses, which makes up our total gross domestic product, if I could speak. So broken down, 100% means that the total market cap is the same as the GDP. So you can kind of see here, back in 2008 when that was that recession, so the total market capitalization, the value of all the businesses compared to the gross domestic product, was about 50%. That is the lowest it about got to be. And so why this is kind of alarming is during a time we were classified as being in a recession, and why did we have the opposite effect here? It doesn't make any sense. So the valuation of all the companies, even though most of them experienced less income and many declared bankruptcy, still the total market capitalization has gone up and the GDP has gone down. So this increase of we're at 3.6%, which is almost 2 times the value of the GDP. Now, this is two things. This has to do with the fact that the GDP had decreased 31.7%, as depicted back here, and the total market capitalization has increased. Like, the value of all these tech stocks are through the roof. Apple goes from $2 to $4 trillion valuation in no time, and it's like, why is this happening? And my biggest prediction, my biggest belief, is that it's because the general population of investors don't want to hold dollars. They didn't want to hold them in the beginning, and they certainly don't want to hold them now because of the printing of money. So it's not too much about the inflation of goods. It's kind of about the inflation of assets. Like, they're just inflating the prices of assets, comparative, because they're driving the demand for purchasing assets rather than the dollar itself. So the value of the dollar decreases, and the value ultimately of all the companies increases. While the production doesn't really matter, because they would rather have their money placed in a company rather than cash. So that's kind of what this chart is telling me, and it's pretty boggling. And looking at smaller businesses, which is kind of how these are, they claim that, and I agree with the fact that the low interest rate policies have created a stock market and bond market bubble. So these larger companies are able to profit and make more money while not making money, but just like reach higher evaluations. And then the bond market is also overpriced comparative to the yields that they bring out. But small businesses are not reopening. They're not really reacting very much. They do react, but they're not really reacting much to the current situation positively. So this chart depicts it very nicely. We had the first COVID case back in January 20th. And so the opening of small businesses, more businesses have been formed and opening, and that was all great until March 13th, when it was declared a national emergency. Massive amounts of company closures, which peaked at about 30% of all small businesses closing. And after the CARES Act was enabled, we got a little bit of a reopening, a little bit of the restructuring of how businesses are interacting with customers. And ever since July, it's been kind of sloping back off again. And it's kind of like a reaction of the acts kind of not... It expired, essentially. The CARES Act is no longer in effect as of sometime in late July. I don't remember that exact date, but it was either the last day of July or sometime right before that. So we had this massive slope off right after that happened, and small businesses so many of them are still remained closed with no help currently. And the only help solution that the government sees fit would damage our money valuations. So it's pretty interesting stuff. Now, the Federal Reserve has only managed to drown U.S. businesses in more debt, as delinquencies are rising on record corporate business debt levels. So, cracking the knuckles here for this one. Got to get really into it. Non-financial corporate business debt. Corporate businesses not associated with financials in any way. So these aren't banks or hedge funds or anything to do with money. They're nothing to do with money. All to do with everything else. So this is their debt level depicted by the blue line, and the net charge-offs, so every loan, lease, commercial, and industrial, all commercial banks, and then the delinquencies of all loans on those leases or commercial. So any lease or loan, these are the charge-offs. So that they're just saying, hey, you clearly can't pay this anymore, so we're just gonna write it off, and then you just go off and do somewhere else. There's no business to be made here, and we're gonna go try to make our money somewhere else. So we have reached this level, this magnitude of debt in the non-financial corporate businesses, and also have had a spike, not too much as in 2018, because this was not 2018, 2008, 2009, because this was mainly caused by the financial the financial sector, and then the government bailed them out, and they were able to do all the charge-offs. So that's basically what this is all here, and we're kind of headed back towards that way. The government was able to provide some liquidity to allow banks to charge off some bad debt. But what level could this arise to? I think we have another spike bigger than this one coming in the future. So, takeaway from this, non-financial corporate debt is approaching an all-time high, if it is not already at the all-time high, and the charge-offs are racing a little bit below that. So, continuing on, this kind of digs into the article that I talked about briefly yesterday. I don't know if I told it as an article, but the Federal Reserve Chairman Jay Powell announced that he's going to let inflation run hotter than normal to keep interest rates at 0%, and he's expected to do this for the next 5 years. 5 years of letting inflation run hotter than normal to keep the interest rates at 0%. Interest rate is basically the demand for the money. So having no demand for money, essentially, is what this means. No demand for money, inflation running hotter than normal, 5 years. That's a lot of inflation. That is a lot of inflation. That's not a lot of money being borrowed. So, however, the money doesn't grow on trees. As the Federal Reserve prints more money to buy up assets, the US dollar will plunge and inflation will rise. Now, the US dollar, this is the expenditures in terms of how much money that we've been spending. And here is the value of the US dollar weighted for buying goods and services. This is a big one here. So this is the trade weighted, the value of the US dollar, essentially, comparative to the massive amount of spending, which is incredible, truly. So we had this massive spike down here comparative to normal spending, and then the value of the dollar is following in suit. Not as directly correlated, depicted by this graph, but definitely correlated to some degree. And perhaps it hasn't completely settled in its spot yet, at least quite yet. Well, with all that being said, we're going to be going on to the consumer price index and the business sector. So, The outputs of the non-farm business sector are in the blue, and the consumer price index is in the red. And that's going to be on here. This is going to be the CPI, and this will be the non-farm business sector output. So the output is through. We got this big ass. We got this big ass spike, 10%, 12%, and we got the CPI decreasing, and this is as expected. The outputs are continuing, and the CPI has stayed at surprisingly about 0. The CPI being the price index for goods. So this is very interesting comparative to we do get these big divergences during recessions. I will say that this 2008 we had the a real output increase to about 5%, and then the CPI decreasing back down to a negative rate. Very interesting stuff. And so what we're talking about now is Warren Buffett and what he's kind of thinking. And he's thinking gold. He's thinking that's pretty much it. Gold and gold miners. So, and then they also put up this chart. I kind of want to look at this real quick because it shows just how much I hate banks. So the value of these corporations, here's June, the amount of shares in the value, and then March, and then the change from quarter 2 to quarter 1, the difference between the 2 quarters. And if you look, most of these are banks. We got Wells Fargo, U.S. Bancorp, a Bank of New York, we got J.P. Morgan, Visa, MasterCard, we got M&T Bank Corp. So a lot of these banks highlighted in the orange here have values that are roughly, $3 million down. No, wait. That is, so you add another 3, that's $3 billion. I forgot to look at the little key here. So that's $3 billion down. Same with J.P. Morgan. Visa somehow has actually had an increase from quarter 1 to quarter 2. MasterCard did the same, and these are not big numbers, guys. These are not big numbers, and I think that was just because people were then able to pay off their credit cards, because that's basically Visa and MasterCard right there. And then the M&T Bank down, but the gold corporations have been doing very well. We're sitting at $500 million increase in value, and that's kind of just what Warren Buffett's kind of saying. He's going gold. He's going gold miners. Those are going to be the most profitable sectors during this recession because gold has a store of value, or can function as one. So that is that article. I hope I did well, and it kind of backs the article that I shared with you guys yesterday, the case for the $500,000 Bitcoin, and it's kind of the same as what the Winklevosses have said. So, will Bitcoin reach $500,000? Probably. I'm more confident about it today than it was yesterday. Is it going to be tomorrow? No. Is it going to be the next 2 years? No, probably not. But after 3 cycles, I think it's very likely. I think it's very likely that Bitcoin is going to be in these upper price ranges, just because of its anti-inflationary evaluation, or its model. If it's anti-inflationary, and then the U.S. dollar goes through this hyperinflation like we've seen in Venezuela and other other countries, then the 500,000 is not that unrealistic. So I think I've rambled on enough. I've talked very much. I can barely even feel my own throat. It has been talked off so much, and I've took a few takes of this before landing on this one. So I hope you guys found some value here. I hope I solidified some points of view and gave you guys some good information. And if I did, go ahead and follow me on Twitter. Go ahead and like the video, subscribe if you want some more. So thank you all for tuning in, and I will see you guys in the next video. Peace out.